Hey everyone, and thanks for jumping back into the equityverse. Today we're going to be talking about the S&P 500 and long-term investing to build your wealth. So if you guys like the content, please go ahead and subscribe to the channel, give the video a thumbs up, and also turn on your alerts if you want to be alerted of new videos where we talk more about data science and quantitative finance and how you can apply it to markets. So what we're going to be talking about today is how you can, build your wealth over a longer period of time. Of course, there's more focused investing that you may want to do, speculate on stocks here and there. But for the most part, people do have, exposure to, say, index funds or ETFs, whatever it may be. And if you are somewhat tracking, if those are tracking, say, the S&P 500, then I want to go over some of the longer term stats for the S&P 500 so that you can better understand, what you could expect if you want to retire in, say, 20 years, 40 years. Where could your valuation of your portfolio be at that time? So again, please subscribe to the channel and let's go ahead and get started. So the first chart here, we're just looking at the price of the S&P 500 versus time. And note that this is a logarithmic scale, so each move up from each major tick is another 10x move, okay? Now it's color-coded based on a risk metric that I made that just accounts for diminishing, or accounts for, say, volatility, macro level volatility, and just time basically. So this is the risk metric that's color coded, and it just goes from 0 to 1. So I use it to just try to help identify low points in the market to move into the market, and if we're near a higher point in the market, to potentially be taking profits. But with that said, that's not the main focus of this video. What we're talking about here is more so longer term investing. So the first thing I want to look at is, what if you invested in 1940 and then you retired in 1980? What was the difference in the price of the S&P 500 during that period of time? Now, of course, there's all sorts of nuances to this. I mean, there's dividends and all this other stuff, but I'm just going to focus on just the absolute price of the S&P 500 for this video. Now, of course, if you're putting money into the market in 1940, then you're likely continuing to do it for years and years and years and years. And then by the year 1980, maybe you've retired after 40 years. Then from when you started putting money into the market to where it is at that day that you retire potentially, then it could be up 10x. Now, of course, not all of your investments would be up 10x. In fact, some of your shorter term moves into the market might actually be down some. But for the most part, you can see it trends up, okay? Now, what if you also did it from, say, 1960 to 2000? Well, if you had started here, which also happened to be a high point, whereas this one was more, say, in the middle, but if you had started in 1960 and invested for 40 years, then the difference between the low point and the high point would have been 27.7x, okay? And then from 1980 to 2000, it would have been a 32x. You would have gone from around $100 because you would have started investing when it was kind of on the lower end, and then you would have been selling right where it was near the top of this longer term imaginary line. So, we talk about, investing in stock markets or in the stock market and growing your wealth over a longer period of time. And people say, well, you put it in there and you wait for it to grow. And it's true. I mean, the market does tend to go up over the long term. And remember, this is a logarithmic scale. Okay. Now, the issue is, well, what if you want to take profits sooner? What if you only want to have it in the market for 10 years? Well, the issue with that is this is your running 10-year ROI. So you can see that there are times when your break-even point of 1, meaning it's worth the same now as it was 10 years ago, there's plenty of times where it goes below that. And this, remember, it's a log scale, so this is 0.5. It even went lower than 0.5 at one point over here. So you have to remember that a 10-year move could still yield a loss, really, because even if it's 1, you're still dealing with the fact that you did not keep up with inflation at all. You can see that in the short term that the 10-year ROI does tend to be capped at around 4x. So, back in this region over here, it went up to 4x or 4x in 1960. So that means had you been buying since 1950, then it would have been worth about 4 times as much in 1960. And then also in 2000, it would have been worth around 4 times as much. Okay. Currently, we recently made it up to that 4x point, but it's possible that we come right back up to it, because you can see previous times over here we came up to it, retraced, and then went back up higher, up to even 5x over 10 years. Now, where this becomes important in terms of, say, building wealth is if you're doing this over a really long period of time, like 40 years. If you're doing it over 40 years, you can see that you're running 40-year ROI of the S&P 500. It starts in 1970 because you have to have 40 years of data before you can have a 40-year return on investment. You can see that it starts at around a 3x at minimum, and it's been trending upwards. So the trend here has been continuing to go up. Sometimes it's near the top of the trend, sometimes it's near the bottom, but it does tend to go up. And currently at the top of the trend would be about a 30, so this is 10, 20, 30, so 40. So we're currently near, say, the 40 to 50 point as our theoretical max. I mean, we could obviously go through it just like we did over here, but this would be on a 40-year ROI of putting money in, say, the stock market. And had you been doing it for 40 years ago, then you could imagine that your upper limit here might be approaching, say, a 40 or 50x over the course of those 40 years. The 10-year ROI doesn't show the same type of trend. The 10-year ROI shows that it's more or less a wash. It does slightly tend to increase, but not very much. It more or less just oscillates in this region. And so you really need to be careful about, say, if you're wanting to buy a house in, say, 2 years and you're putting money into the market, well, I mean, there's a good chance that, in 2 years' time, then that money could be worth less than it's worth today. There's also a chance that it could be worth a lot more than it's worth today. The thing is if you put, say, like if you mandate that you have to withdraw that money at a specific time, then that's really hurtful to your finances. If you give yourself the flexibility to say, you know what, we want to buy a house in, maybe 3 years, but we could wait 6 years, or you give yourself some flexibility, then you can grow your wealth with a lot less stress. Okay, and this is the whole point of investing in these. If you are following the S&P 500, of course you probably also have some exposure to individual stocks and other asset classes. But a lot of people do have some exposure just to, say, like an ETF or something that tracks the S&P 500. And so this is just something you need to consider. We really don't know where it's going to go in the short term. What we do know is over the long term, it does tend to trend upwards. And you can see again that the 40-year ROI is fairly impressive. So again, this is the trend. If we were to speculate where the S&P 500 could be by the year 2040, if we were to stay within this trend, then our lower bound would be around here. Our upper bound is up here. Note that it is possible that we go above this curve. You can see the speculative bubble around the dot-com bubble in 2000. We did go above it, but we did crash back under it and then stayed within that upper trend line for a long time before then crashing down here around 2008. Okay, so we continue moving back up. We're at the top of the band now. Even with the pandemic and everything, we did not come back down to the bottom of it. So you can't imagine that this might. I mean, a lot of people would think that the stock market does follow the economy, but so far, you have to remember that the stock markets can stay irrational longer than you can stay solvent if you're, say if you're leveraged or you need the money. So you just have to consider that possibility. Over here, we hugged the top of this curve for, years and years. I mean, from the 1950s to, the 1970s or so before it started to come back down to the bottom of the curve. So if we were, say, at the bottom of the curve, then the S&P 500 by 2040 would be worth around $5,000. So if you imagine it comes back down and then slowly starts to work its way up. If, on the other hand, we remain really bullish, and we follow this trend, then it could be worth up to maybe $13,000 at the upper part of the trend line by the year 2040. So a $13,000 would obviously be around a 4x, 4x or a little bit more around that area from current prices. By the year 2060, so if you're planning on working for the next 40 years, you're putting money into the market, and you see the price of the S&P 500 is around $3,000 or so, and you're worried, okay, is it going to dip down to 2,800 or is it going to go up to 3,200? If you're in it for the long haul and you just want to make sure you have money for retirement, then the lower bound at this region would be 19,000, and then the upper bound would be around 50,000. So just consider this because, again, no one knows what it's going to do. And, obviously, I personally have exposure to individual stocks. I have exposure to other asset classes. But I also have some exposure just to a more safer type of investment to just make sure that, some of my wealth is more stable and it's not just necessarily going to completely disappear tomorrow. Because this index does tend to just slowly move up over a long period of time. Now, one of the things I wanted to talk about is the time between kind of when we're at the bottom of this, like of this trend line. So here it was around 32 years between bottom to bottom, and that was from 1942 to 1974. From 74 to 2009, it was 35 years. So if we were to say go another 30 to 40 years, it could put us from 2009, it could put us back at the bottom of this sometime, maybe around 2040 to 2050 or so. And the reason why this is important is because, if you it really is unfortunate if you really need the money at a time when it hits that bottom point. Because ideally speaking, you're taking advantage when it's more bullish, and putting money into the market when it's down here, putting more money into the market so then you can capitalize on it really quickly. Because we don't tend to stay in this lower risk region very long. When we come down here, we then start to rebound and just slowly work our way back up. So if one potential outcome would be for us to continue hugging the top of this curve for a long period of time, maybe even seeing another bubble one day and then coming back down before ultimately continuing to trend back up. We know with the economy there's like an ebb and flow to the markets, the boom and bust cycles. That's just how the economy is. So even though it sounds ridiculous that the price of the S&P could only be $5,000 by 2040, when you have moves like this that they drop this significantly, you have to consider that it could be a point in time where something like that were to happen. Maybe it goes up to a $10,000 valuation and then does retrace back down to say $5,000 or something. This is always a possibility. So just longer term outlook, looking at building your wealth over a longer period of time, it's important to have more of the flexibility so where you don't need the money. If you don't need it, then you don't have to pull it out of the market and take that loss. This is the key thing. If you draw, say, a trend line down the middle, and let me remove the rest of the stuff, you can kind of see that ebb and flow to the market where it goes through like these undervaluation, overvaluation, undervaluation, over if we continue projecting outwards. So this is the general idea of the market, and I want you guys to be aware of this general move so that you can just take advantage of it, and so that you're not stuck having to capitulate when the market sees a move like this, which it inevitably will at some point. If you take the color code out and just draw the risk metric on the secondary y-axis, this is what it looks like, the red line, so it's on the secondary y-axis. And then if you look to see, okay, well, this is when, if we take this as our starting point, not the Great Depression, but if you take this as your starting point, you can see it's between 30 to 35 years before we get into that 0.1 to 0.2 risk regime. So if we were to continue along this path, then it would be around 2040 before it would happen again. Now, if you look at, say, this regime from 0.2 to 0.3, we do come down to that more often. We made a video on this back in March, said that the risk just dipped down to 0.29, and this is historically a great time to get into stocks. We talked about that. We talked about those index funds back in March, so go back and watch that video if you missed it. Certainly the risk level is higher now. If we zoom in, you can see that we're back up to that, between the 0.6 and 0.7 risk regime. And if we zoom in even more, you can see that we often only go up to around 0.8. We rarely get to that 0.9 to 1 risk regime, as you can see over here. Looking at 0.9, it doesn't really happen that often. But looking at 0.8, when we do get to the 0.8 risk regime, we don't tend to stay there very long. And this is the key thing. So with that said, you can see the risk metric, and you can see how quickly we came down. So, for everyone who is buying at these times, congratulations, because even if you started buying here and it continued going down, this is irrelevant to you because you're a longer term investor. If you're following, if this video is interesting to you, then most likely you're a longer term investor, and you don't care if it continues going down because you recognize a bargain when you see one. You're going against the market. You recognize that you're not going to be able to time the bottom and you're not going to be able to time the top, but you enter the market when it's really attractive to enter, and then you exit the market when you're up significantly and the risk is getting, say, close to 0.75, 0.8, and you just want to get out of the market. So I hope this video is informative to everyone looking at more of a macro level view of investing in the stock market, the S&P 500 as your index or whatever. If you guys like the content, please subscribe to the channel. We do have a website where you can access premium content at intothecryptoverse.com, so please check that out. We talk about not just crypto, even though it's called Into the Cryptoverse. We talk about stocks and precious metals, all sorts of things. So please check it out. We do have a growing community there, and I put out a premium video, a premium report, and a private Telegram channel with some alerts. So please check that out if you find that interesting. If not, please subscribe to the channel, and I'll see you guys next time. Thanks for tuning in. Bye.